All right, everybody, welcome to the investment committee. The end of March is here. We've had quite an interesting news cycle that's been coming our way. We're missing one of our committee members today, Sean. He's unfortunately sidelined with some sort of stomach virus. So we're going to try to piece this together as best as possible, missing that key member of our group because he always does a great job presenting for us, and we're going to miss him. But I'm sure
He's
he's
also missing his
from.
playoff game, his basketball playoff game. So, we know it's for real. He had
It's
that,
real.
he had the rebound record to defend. What's the name of the guy
So
who's
listen, what's that?
what's the name of the guy who's in second place who's going to steal the rebound, the league
Who
rebound?
remembers the guy who's in second place? That's the whole problem. That's the whole problem. That's why he's got to stay in first.
He's got to show to his game or whatever.
So we've had quite a news cycle. We've had quite a market over the past couple of months. This is just a pickup and a continuation of February, and want to go through some of the key items that we've pointed out, and then just go over some of the numbers too, so this way everybody is kind of on the same page as the way we're thinking about the markets and all of the changes that have transpired, since the beginning of the year. So, Brenda, you want to throw that up?
Yes, sir. Pull it up.
So one of the things that I think is interesting in our position is when we look at the markets, there's the emotional side and then there's the logical side. And obviously emotions have been high with really polarized views on politics, on geopolitics, on everything that's happening domestically. And I think really what we want to do today is just kind of make some sense of the numbers and not get too deep into the politics, but really talk about headlines and talk about our thoughts and how we are addressing these crazy markets.
Yeah. So, we always kind of start with the review of the market vitals, starting with just the S&P year to date down about 1.7%. This data is as of Monday, but that's right around where it is in the last month, if you're looking, down about 3.5%. I think, Bobby, going to your point about that of the headline news in your face, what's going on with tariffs. S&P is only down about 1.7 year to date, where looking at it at face value, if you're just reading the news, you might think it's down a little bit more. Obviously, there's a little more volatility in that time period, but overall, that's kind of what you're seeing year to date. I think another big point on this slide is the US dollar, down this year. I know, Jordan, there's some points you want to bring up with that. But also, I think a big takeaway is when you're looking at the major index performances, if you're looking at the S&P, the NASDAQ, both down. But, if you're looking at the Vanguard Total International Stock Index, up around 8% year to date. So seeing that big, difference between what's going on in the S&P, the NASDAQ, versus internationally is a big difference, and we'll go into that a little bit more details on the next slide. But I think that's a pretty big takeaway and glaring number of that being up 8% versus the S&P being down 1.5.
Yeah, I think just quick thing I'd add to that, Brandon, why people probably feel like this is a little bit more intense than what the numbers on the year to date state is we really hit the high in the market right around February 19th this year. And then we had a pretty fast 10% drop. And it happened in 3 consecutive weeks. And it felt like there wasn't one up day. And it coincided with a lot of headline news coming from tariffs and conflict happening between international countries. And I think, that had people clued into the news, and we were watching the news with the ticker right next to it. And that made it feel a little bit more in the face, I think, than we would have expected. But to your point, you're measuring from a high to a low point versus measuring over a longer period. We really only went back to October when you look at what transpired, because the market had rallied so much kind of post-election, and through January and even into February, we had rallied so much that we just kind of gave back some of those gains as people tried to make sense about what was going on. and it felt more violent than probably if you took a zoom out view. It wasn't as crazy. Like we'll forget about this in a few years would be the way I might think about it. This downturn, if it doesn't cascade from here. Does that make sense?
Yeah, I think that I think we're finding ourselves back into a louder administration, one that isn't shy to kind of create a little turmoil in the news cycle. And and that's coming off of 4 years of a really boring 4 years, so to speak. And there's also a lot of assumptions that are baked in with his rhetoric and the things that he says, and people are guessing, is it going to last a week? Is it going to last a month? Is it going to be permanent? Is it going to be specific countries? Is it going to be blanketed tariffs? Is it going to be just pointed toward certain industries? So I think that there's so many question marks around a lot of it, and it's so loud and in our face. Then markets don't like uncertainty, and that's kind of what it boils down to as well.
It's almost also like whatever's been supported in the rhetoric is almost what's done the opposite. So like the administration's been relatively positive towards Bitcoin, and Bitcoin rallied, before the administration took office. Bitcoin hasn't really had a great time since, but they're very Bitcoin friendly generally, cryptocurrency friendly, I would call. And it's been very pro-America. America hasn't done as well as international markets. It's been very anti-China. China's up over 20% this year. So it's kind of interesting that we kind of, before the administration took office, some of these things were happening the way that you would expect and the way they would market the story. And then since they've taken office, it's almost been like a buy the rumors, sell the news. That's a typical phrase we'll use on Wall Street, where you might think a company is about to have really good earnings. The company rallies into those earnings. The earnings are released, and then the company will sell off. We call that buy the rumor, sell the news. And that's a little bit of what it seems like has happened in some ways with things like Bitcoin and cryptocurrency. As this administration took office, there was a little bit of people were buying into the expectations. And then since then, things have sold off a little bit.
And like, if you look at the international markets, I mean, why they've underperformed and then now all of a sudden they're overperforming is just because of all the uncertainty over here in the tariffs and our consumption or our GDP, the weakening of the dollar. There's a lot also in that number that is speculative as to the strength of the country, given where we are going and how the ultimate outcomes are going to turn out with the prospective tariffs.
We have a whole slide on that, by the way.
That was great segue.
Brandon, what do you think about the sector
for you,
performance? Brandon, as we look at the sector performance, what jumps out at you here?
Yeah, so I mean, I think one of the things with the sectors is, when you're looking at technology or, consumer discretionary, is when you're looking at that, the 1 year to date performance, obviously they're down, but then also in 1 month. So you're not really seeing, that recovery versus if you're looking at, energy, it's done well year to date, but then also has that positive momentum, in the really short term of that 1 month. And then also if you're looking at, healthcare or financials, which is up on year to date. And it's kind of just managing around that, 1 month being down about 1%. But I think with the sectors, it's good to look at and, give a good showing of being more, thoughtful and logical and kind of picking your piece of what's been doing well, why it's been doing well, or if things have.
This is indicative of a bear market, right? I mean, this is like a lineup of a bear. If you flip this around, it's the lineup of a bull. So
Yeah, the financial sector being up kind of, is usually, but to your point, healthcare, utilities, typically defensive sectors, whereas technology, consumer discretionary, technically cyclical. Consumer discretionary, though, I would be a little careful there. About 35% of that index is Tesla and Amazon. So Tesla has kind of been trading off of a non-macro story, a little bit more of a micro story around Elon and, just kind of how his political career is impacting that brand, that company, since he's a very extrovert CEO, and he's decided to, be a headline every week with some of his actions, and not every consumer is a fan.
Mhm.
They're certainly not a fan in Europe, where sales of Tesla were down about 45% month over month. So that wasn't great.
All right, Brando, move us forward.
All right, so here we have a table looking at international versus the S&P. So it's broken down into different time frames. So, back to Bobby's point of, if you're looking at the total returns on over the past 15 years, you can see there's a pretty drastic gap between what the S&P's done and international. But really, as you start getting closer in time, you're starting to see that gap really close. If you're looking at 3 years, 24% to 32, and then 1 year, it's obviously closer. But I mean, the drastic difference in year to date of that outperformance of international versus the S&P. So where over that long period of time, you might be overweight the S&P, the US, and those stocks, ETFs. You're starting to see that shift of international really have its day, and especially with that kind of outperformance so far this year.
Yeah,
I think the big question.
Sorry, Bobby, go ahead.
No, I was just going to say, I think the big question in the market is whether or not the U.S. is going to continue to lead the way, or if there's going to be more of a global participation versus U.S. driving.
Yeah, this has been something, if you go back to when asset allocation and diversification was really being supported, was international stocks were performing about in line with US stocks looked at over longer periods, and there was some diversification benefit. In other words, being allocated away from the dollar, having different economies, kind of, going through different cycles at different times. There was a diversification benefit way back when, before the world became a little bit more global. That diversification benefit started to erode as new data came in and everything became much, much more correlated, or started moving more in lockstep. So the expression used to be, if the US catches a cold, the world gets the flu. And so you generally just started to see that if the US economy started to stumble, all the economies were kind of stumbling in lockstep. So there wasn't a lot of diversification benefit. And then the US would generally recover faster and international stocks would lag. It's kind of been the story for about 20 years or so. And that has caused people, there was a period of time where the US dollar was weak after the tech bubble, and international stocks did really well. It was really on the heels of oil being very strong, oil going to ultimately $150 a barrel, and a lot of natural resources, other countries, Brazil in particular. That was a country which did very, very well. Its economy did very well because oil was going up. They have a lot of oil resources, and so the country was doing well. The stocks were doing well. Then the financial crisis hit. Oil went from 150 to where it sits now, a little bit below $70 a barrel. Those countries started to lag. You didn't get that benefit of natural resources, and technology, big data, mobile, all of those things really took off. And that is where the United States is the epicenter. During that period of time, there are two things that cause stocks to go up if you kind of break it down. One is going to be fundamental growth. So the US economy, basically revenue grew somewhere around 8% across US companies in the S&P. If you look at the MSCI EFA, revenue grew around 5%. The US was growing faster. On top of that, the multiples that people pay, that's the price times earnings that people would pay. In the US, it went from the mid-teens to right now, it's about 22 times per earning. Whereas in the MSCI EFA, start around 12, it's currently around 14. So we didn't have as much what you would call multiple expansion. In other words, people paying more per dollar of earning. They really we're paying a lot more in the United States. We think that a dollar of earnings in the United States is worth more than a dollar of earnings in the international markets. And so there's been a premium that we would pay for American stocks. The question that a lot of professionals have asked is, does America deserve that premium? A premium of what's right now 8 times more paid per dollar of earnings. And that's a question that a lot of professionals have asked for many years. Everyone knew about this kind of table that we have right here. It's not unknown, but we're starting every time we see a little outperformance in the international, people say maybe it's time for them to catch up. And that's something that, I think we don't know yet, but that's a pretty big gap, 11% versus minus 1.5%. That's a pretty big gap for something that, we haven't really seen a lot of gaps like that. It happens very infrequently in this 15-year period.
Right, but the question is there going to be follow through? How much follow through there's going to be, and also how much follow through domestically, in our political environment, how much follow through is there going to be? Too early to make those kinds of decisions, just like you said. I mean, just can't do it.
Well, the question becomes, in some sense, the fundamentals are going to be the fundamentals. Either the stocks are going to grow in the US, continue to grow faster, and that will cause, just generally the fundamental growth to be faster. But if people decide that they don't want to pay a higher multiple, or they're not willing to pay as high of a multiple, right now, if you do, there's a way of kind of coming up with a standardized formula for it. It's called the price to earnings divided by growth. If you do that, it's what we call the PEG ratio. You end up with about 3 times in both markets if you take the historic growth rate. So the question becomes, are people concerned that the US's growth rate might shrink as we shrink potentially government spending, which is part of our economy? If you take government spending down, you're going to see some of our GDP drop. And then the other concern is consumer sentiment has come down recently. Recent report this week showed consumer sentiment continuing to drop. When consumer sentiment drops, it usually means they spend less. That causes concern over an economic decline. So people are starting to worry about the US's growth rate, which would make it look more expensive than international. On top of that, international countries are talking about spending a lot more, kicking up their defense spending, becoming a little bit more self-reliant in the face of some of the trade banter that's gone back and forth. And this has caused the investment community to feel a little more optimistic about where their growth trajectory is versus the US's. And to your point, is it going to have follow through, Bobby? We don't know yet.
Right, and that ultimately will strengthen international countries with all of their own domestic spending. And where do we see that kind of go?
Yeah, and I mean, ultimately, we've been running a huge deficit. Not that international countries haven't. We've all been running a huge deficit, but it seems like we're starting to hit the brakes hard, and in result, they might have to actually hit the accelerator, and that might be good for their markets.
All right, Brando.
All right, on to some recent news stories. I think the 2 big ones that have, kind of been in everyone's face, mainly the tariffs. And then also, talking about the Federal Reserve meeting that was last week. So, looking at tariffs.
Brando, let me just, just for clarification purposes, so people understand in the case that they're not caught up to speed on actually how tariffs work, is when we import from other countries, there's a tariff that ends up being a tax that the consumer ends up paying over here. So when we're tariffing and those goods are coming over, that tax is getting paid, and it's making the goods and services, the goods more expensive over here.
Mm-hmm. Yeah. So, I mean, if you're looking at the tariffs and kind of what's been enacted or said so far, obviously there was the 25% on Canada and Mexico, which then was backed off and waiting till, April 2nd to see what happens there. There was the tariff on China, and then also a 25% import on steel and aluminum. And then, looking forward, one of the key dates that has been talked about is April 2nd. And what reciprocal tariffs will be announced or, enacted upon that. So, what countries kind of have in place for the US, what will we do to them if it will be, similar or a different amount? And, really to look for on that, I think is, what's kind of being said or used as almost a negotiation tactic versus what's the final answer. And then also, looking at the sectors as we had on, the first slide, what's being impacted? Is it a specific industry or sector, or is it kind of a blanketed tariff saying 25% on, X country or whatever that percent might be? And then, kind of looking at, all right, so, these tariffs have been announced once they are. What's done well during those announcement periods? What's kind of faltered or underperformed during them? And really, taking a step back and looking at it, kind of logically and putting analysis towards it, instead of just kind of reading it at face value and seeing, what are some tactical shifts that may or may not need to be made based off of, what's actually happening versus some of the rhetoric that you're really hearing.
So what's interesting is if we look back just kind of how the supply chain management has changed across different industries post-COVID, it's going to be interesting to see when these tariffs are enacted in certain countries, how much of it gets just moved to a different sourcing point. And also, what is going to replace certain goods or items that are replaceable. And I think that, when we start to really look at how this is going to have an overall impact, it's going to be a little bit more difficult than just taking it at face value.
Yeah, it's interesting you mentioned the supply chain. So because of COVID, a lot of companies had to figure out how to get things from unusual sources. So it's kind of good training for the situation we're in. It's not the first time tariffs have been talked about or done. For instance, if you put a tariff on China, one way to get around it that some companies did is they'd ship things to Vietnam and then ship things out of Vietnam and just kind of mess with the paperwork so nobody realized that it came from China originally. Obviously, they're trying to police these things, but tariffs normally they're put in place for kind of three reasons. One, national defense. You could make a pretty good argument why steel and aluminum we would want to make in America, because if we end up needing steel and aluminum and we're receiving cheap steel and aluminum from other sources, we have a conflict with them. Suddenly, we don't have a way to get steel and aluminum. So there's a national defense rationale behind creating things within your own borders and putting tariffs to protect those industries. There's another possible reason. For instance, Alexander Hamilton was a huge fan of tariffs, but it was because our industrial complex was in infancy versus Europe's. And so you have tariffs to kind of put in place to protect an industry for long enough for it to catch up. And then you could also kind of say, hey, I want tariffs as a tax revenue format. Instead of paying income tax, I want sales tax. And I don't want to tax American companies. I just want to tax foreign companies as a sales tax. So I'm going to put tariffs on foreign goods. And if you really want to own a, Mercedes versus a Cadillac, that's on you. You're going to pay that extra sales tax on that product. In this particular case, the tariffs, there seems to be kind of a splurge of reasons on why we're having them. And I think that's causing a little bit more confusion for the market than when we typically see tariffs, because they're not that crazy, and even the administration is talking about reciprocal tariffs. These are tariffs that have existed, but they exist for different reasons. And they exist based on, usually some combination of some of the concepts that were just mentioned, either, national defense reasons, an infancy of industrial production, or, some separate sales tax reason. Europe has a VAT tax, for instance, which has been misclassified as a tariff in some ways. But I guess you could call it a tariff because it's value added tax that's done within a country. And so, they just kind of market it a little bit differently. But, it is, I think the market's more confused on how it's being presented, and the way it's happening very publicly and very much on the news, as opposed to typically these things are kind of done a little bit more behind closed doors. And you don't see all the, tit for tat that we're kind of seeing very publicly and kind of all over social media. And I think it just causes a little bit of shock and awe to see how it's going about. Not as much, 25% tariff, a 10% tariff. Yeah, it makes a big deal. But the expectation is that, you wouldn't expect it to be rolled out this quickly. But if prices went up kind of over time and it was handled a little bit more smoothly, I don't think the market would be nearly as shocked as it's acted. In other words, the rhetoric and the way it's gone about seems to be a little bit more impactful than probably what the actual, 2 to 3 year impact of these policies would be. Did that all make sense?
Well,
I've said a lot.
you've got the showmanship of it to see, and the questions of why is it actually happening and why is this showmanship happening? Is it for a deal? Is it for a power play? Why is it really to reduce our debt? Is it going to change our tax, our tax formats in the US in terms of how we pay taxes? There's so many what ifs because of how loud and how frequent we're hearing it in the news cycle. So, again, markets don't like uncertainty, and we really don't know what the end game is here because it seems to change depending on who the intended audience is a little bit. Is that fair
Yeah,
to
it does
say?
seem like it seems like we're over transparent and we're being a little opaque about why. And it seems, and again, I think the market's hopeful. This is just for negotiating purposes. And even as we get closer to April 2nd, the market is becoming a little bit more and more hopeful that this is just a marketing effort to see if we can make some deals and, hold up some wins. And look, I think there's some real reaction happening here. I think if you're an American company right now, you're thinking about the next 4 years. You're thinking this could be a thing for the next 4 years. You're starting to think maybe I should find some sources in the United States to get this stuff, so I don't have to worry or think about tariffs. And that does have an ultimate effect on potentially more sales done within the borders of this country because you just don't want to have to worry about this stuff. And that does have the effect of, more intertrade within the United States as opposed to trading with our global partners. So that could have a very real effect. And,
And
I
this is
think
also a really deep rabbit hole that we can go down because it's a trickling effect. One thing happens, another thing becomes a problem. So you start to look at, not only sourcing goods from other countries, but then maybe changing the way you do things. Or if you're sourcing it from another country, what's the actual quality versus the initial country that you were receiving those from? How does that change the overall construction of what it is the end product ends up looking like? There's so many different components to this spider web that being observant as opposed to trying to play the guessing game just always puts us in a better driver's seat than really carrying through each of these variables and seeing where they land.
Yeah, and I think we have a question in the chat, and it's about how tariffs will affect international relative to US. And this is really where the rubber is going to meet the road is how does that end up playing out? It seems so far the conversation seems to be if you just take Canada, for instance, Canada basically has gone out publicly and said, Canada's our biggest trading partner. By the way, if you look at, how much we spend and how much we have intertrade with, and it's Canada, Mexico, and China are our three biggest in that order. And, you've had Canada come out and say, we're going to have to start finding other trading partners. We're going to have to start thinking about our dependency on the United States as a trading partner and think about some others. How's that actually going to play out? Will it be more expensive for Canada? Is that ultimately, again, them just posturing? It's really, really tough to say. I think we all kind of hope that, this works itself out and there's, a big, beautiful deal at the end of it. because I think everyone trades with who they trade with for a reason. It's not like we wanted to, buy cheap goods from China. It's that the consumer at some point said, I'd rather have something for $5 that's made in that country than something for 15 that's made here, or whatever, however they figured it out. They've decided they were willing to make that trade. Nobody got forced to do it. And so I think people do it because they want to do it, not because they're forced to. And right now, I think there's going to be pain on both sides if they're
Well,
forced to.
Canada also, I just read something like an hour ago, an informal ban on vacationing here. It's starting to get very tit for tattish.
Yeah. There's another
At
question
least
here about the next 4 to 5 years for someone who's planning on retiring in the next 4 to 5 years, best to stay the course or make changes. That's a tough question to answer without looking at the specifics. I think generally, as you're heading to retirement, it's worth thinking about, should you be making those changes into retirement? Typically, when we're talking to someone and they are going towards retirement, we're talking about the changes that need to be made from pre-retirement to then after retirement, when suddenly you need to start paying yourself your paycheck from your portfolio. There's usually some shifts that are happening. I would say on the plus side, if you feel like you're a little overexposed right now, the market really hasn't, as we said, year to date, down 1.7% or so, with today a little bit more. But that's on the heels of 2 double-digit years, 2023 and 2024. So hopefully your portfolio has kept up during that period of time. If it has, this isn't the worst time to just take a gut check look and figure out. Remember, interest rates are still high, relatively high at least, if you look at the last 15 years. So there's other options out there. When you think about as an investor, and this is sometimes where, I've heard people say this is a terrible time to invest. Cash is paying 4%. Bonds, you're able to get 6, 7, even higher, 8% in fixed income instruments that are traditional fixed income instruments. You have great growth, profit margins. Equities, yeah, they might be a little expensive, but there's rationale there. We might be on an AI revolution. Like, this is actually kind of a good time to be investing. And we've got interest rates coming down, which are traditionally good. So if interest rates continue to come down, I don't know if I would change my total risk profile based on the political atmosphere. We normally say don't invest with your politics. And I don't think this environment's any different from that perspective. You want to keep your discipline. You don't want to become, a victim to watching your favorite news station and letting your favorite newscaster tell you how to invest. That's not a great strategy. I think you stick with your discipline, but if you do have a 4 to 5 year time horizon where your risk profile would normally be shifting, you might decide to keep yourself sane, to adjust how you were planning that shift based on the fact that we're probably going to see a little bit more volatility. And we've been saying the volatility is going to be higher for a while. It always just feels awkward when it shows up, but
I think the one thing that people just need to be careful of, in that thoughtful shift, is that people tend to feel this kind of gut check when they're a little fearful or a little nervous. And if markets do turn, you need to stay disciplined, because what typically ends up happening is you end up selling when it's low, and then all of a sudden you get that FOMO and you change courses because you feel like you're missing or behind the 8 ball, and you usually change too late, and then you end up buying when you're high instead of doing the opposite. So that's why I think Jordan's kind of dancing around, like, craftily, how do you do it when you're approaching retirement, and how do you stay disciplined? Is you don't want to get yourself caught in emotional cycles of watching your news, getting scared, changing because you feel like you need to change, and then readjusting later because your temperament changed, not necessarily the fundamentals of how you were invested. Jordan, is that fair to say?
Yeah, well, I think what you're saying is leave your emotions at the door and make sure you're using your rational hat. It's hard to do when it's yourself. It's hard for, us as human beings to know when we're being emotional or rational and logical, unless someone's there to sit next to us and be like, I don't know if you're being, rational and logical. So for anyone who's thinking about making changes, my recommendation would be consult, with professionals to make sure that it's within a disciplined framework of how it's supposed to be done. And, that I think that should be something that that people are happy to provide. And we got a time check. Thank you for that, Bobby. Federal Reserve rate cuts. What you got, Brando?
Yeah, I mean, I think the real big takeaway was obviously there wasn't a change in the last meeting. They forecasted, maybe 2 rate cuts in 2025. But one of the big things that Jerome Powell, kept saying when he was answering the questions was kind of looping back to the tariff situation is, it's hard to say what will actually kind of happen this year. We don't want to state a definitive course of action because, it's hard to say what tariffs will affect inflation. If inflation goes up, just say like 0.5%, what percent is that of tariffs versus normal things happening? So it's really kind of staying data dependent in that sense, and then kind of analyzing it as it's coming in, and then that will be the kind of the course of action moving forward. So, not a real, stance one way or the other as of right now of how they're moving forward, but also kind of waiting to see, what's going to play out in the tariff space.
Yeah, the funny thing about this is fiscal policy and monetary policy being at odds. You've got, monetary policy, which has been kind of fighting inflation for a while. They finally feel like they've won the fight. And now we've got a big change in fiscal policy. And suddenly monetary policy needs to kind of gut check its direction. It's a weird place to be. I can't recall a time that we've had disconnect of this size between the Federal Reserve and the traditional government, if you will, the fiscal side of government. I don't know if it's a bad thing though. Like I'm not upset that Jerome Powell seems to be feeling like he's reffing the game a little bit on the monetary policy side. I think it's good for the Federal Reserve to be on their toes personally. What do you think, Bobby?
No, I couldn't have said it better. I think it's exactly what the market, the general consumer market is looking for is an opportunity for lower rates. And we've got to be careful in terms of how the Federal Reserve reacts. And I like to see, the activity. I like to see the, having the finger on the pulse, so to speak, as opposed to where we felt we were, a year or a year and a half or 2 years ago, where it was like, are these guys even paying attention? What's going on?
Yeah, I
So,
think I think Brandon said it. The Fed's been talking about being data dependent forever, and I think the market's kind of sick of data dependent, being that they've been wrong twice with their data dependency. They've been slow to raise interest rates. They were slow to cut interest rates. I think the market wants to see a little bit more critical thinking from the Federal Reserve, and that's, I think this gets them awake. So, yeah, I don't think it's bad, but it is unusual. Let's go to the next slide, Brando.
All right, so I mean, the next 2 slides are really kind of looking at some historical data here. So this table
Mark,
shows.
Brando, are you saying you're going to become data dependent here in these 2 slides, or?
I guess that would be an accurate statement. So this table is really showing the number of S&P declines of 10% or more since 1950, and you can really see 23 of them have been between 10 and 20%, where there's been, a lot less that are 20 to 30 or even above that. And I think another important point to, cover is the average time to recover of how long it kind of takes the S&P to get back where it was before those declines. So you can see the 10 to 20%, 4 months versus if you're looking at 30 to 40%, that's almost 2 years. But the number of occurrences are, a lot less. So, I mean, I think going into this and kind of what we've been covering are, some of the main takeaways are, what are the things you're doing to kind of manage that volatility in those times? And then also, kind of looking at the future, is there a potential buying opportunity? Does that, make sense? Are you still looking at, companies that are good fundamentally, where there may not be something specifically wrong, but they're kind of caught in the sell-off or the, sentiment in the market. And how can you work that into, your financial plan? Is it,
And
helpful?
sometimes not even like major shifts. It's like the
Yeah.
S&P 500 versus like the equal weighted S&P 500. Like when are you making just small tactical changes? It doesn't have to be like these huge momentous shifts. Even though we're looking for all types of opportunities throughout the year, sometimes just those little things really make the difference.
Yeah,
Yeah.
for sure. I think it is important here, and we'll sometimes say this, you'll see a 10% decline about once every year. You'll see a 20% decline once every 2.5 years, 30% decline once every 8 years. And anything over a 30% decline, you'll see kind of like once every 12 years. And we like to think about that as opportunity. So if you see, a 30% decline, you should kind of be sitting there saying like, this only happens once every 8 years. This might be a great opportunity. This is a once in an 8-year opportunity right here. And as you said, Bobby, it doesn't have to be major shifts when you see things like this. They can be small. I also think this is, to use one of my cheesy analogies, part of the average time to recover here. The purpose of that is, sometimes you're driving down the highway. I'll get caught in traffic, and you're caught in deadlocks, dead stop traffic, and you say, "Oh my God, how long is this?" And you type in where you're going to the GPS, and it tells you it's a plus 9 minute wait for this traffic. You go, "Oh, okay, it's just 9 minutes. I don't have to freak out." So I think some of the purpose here in the average time to recovery is to just help people understand, like, think about this as time. You got caught in some bad traffic. When you see these kind of drawdowns, how long does it take for the traffic to clear out? And if it's a 10% or 10 to 20%, it's probably going to be a little over a quarter. If it's as much as almost a 30% decline, it's still probably less than a year. So, when you get to those bigger declines, those 30 to 40% declines, which you can see in the last 75 years has only happened 3 or 6 times if you include the bigger declines. So they're very, very rare. And that means the opportunity is very, very big. The other ones, the time to recover is relatively short. So
Yeah,
I
but
think,
even if we look at the average time to recover and we're going back to 1950, how much faster has recovery been in the last 5 years, 6 years, where, you like to use the analogy of taking the stairs down, the elevator up. We
right.
are seeing bounce back in markets due to algorithmic trading, due to accessibility to data and information, people being able to have access to trading faster on their own, lower barriers to entry to make trades.
Don't forget about
Those
an
numbers,
attractive Federal Reserve.
those numbers are also skewed because of the years where they just did that the access to data, the speed wasn't quite as efficient as it
Yeah,
is today.
I think that's correct. I think people are better investors nowadays. There are more professionals, there's better data, there's more confidence in what people are doing. And what you're generally seeing is you're seeing faster recoveries. So when you see declines nowadays, if you look way back, declines took longer to recover from. We're seeing those numbers start to skew to shorter. That's just the data. And, Bobby, I think you pointed to some of the hypotheses on why. We don't really know why. We're, again, just looking and observing and trying to make sense of it. But it is factual. If you thought it takes 4 months to recover and it ends up taking only 3 or 2.5, the data is directionally moving to shorter as opposed to longer, which basically means if you figure, oh, it's down, 10 or 20%, I'll just take the next 4 months off. You might miss it. And that's something we're cognizant of. But, and I think I don't know, is that a good thing? Because our declines are also a little sharper and faster. So basically
Well, you
markets,
can't fall.
yeah, markets are just crazier. I don't know.
Brando, let's
See
wrap
next,
this up because we
Brandon?
got 45 minutes and there's a whole bunch of people here that are probably totally enamored by our data and information, but probably have someplace to go as well. So,
We gotta love the data. All right.
All right,
Let's be-
Brandon, why don't you hit us with the heavy numbers?
Going back to, your guys' point about kind of the steep declines, you can see from, just this year, February 19th to March 13th, we kind of saw the S&P drop 10%. And then this is really looking back over, years that have had quick declines, and then what's happened over 1 month, 3 months, 6 months, and a year afterwards from that. And if you're looking every year after some of these corrections, there's only 1 year where you had negative returns still, and that was 2000. And if you're looking over, 3 and 6 months, those have all had positive returns in this, scenario. And as you're breaking that out to 1 year too, you can see that could potentially be, double-digit returns. So, kind of the points you guys mentioned and we all mentioned during the last slide, it's a little bit about, adjusting the perspective and kind of taking a step back and seeing where everything is versus, it can be hard sometimes when you're watching the news, the market's on TV, and you're kind of seeing those declines happen day after day. But kind of taking a
past
step.
performance is not indicative of future returns. Sorry, I just had to throw that in there.
Correct. Also correct.
Yeah, I don't think this is so much suggesting a trading strategy as much as it's just pointing that usually from all-time highs, you get a decent amount of pullbacks from all-time highs. They tend to be pretty steep and sharp, and oftentimes there's a recovery afterwards. We don't know if this time is different. We don't know what's going to happen, but that kind of brings us to, I think, our next slide. But before we go, I think the most important thing there is the percentage of time that we will see the market higher 12 months later. The percentage is higher after a decline. The probability is higher after a decline than just on average. And that's kind of obvious, right? If the market's going up and it's moving in this direction long term, the best time, if we believe this to be true, the best time to buy is when it's trading below trend.
Yep. And so this is the last slide showing, S&P 500 after correction, whether there, is a recession and then beginning within the next year, how does that path kind of play out versus, an S&P 500 10% decline? What if there's no recession? And you can kind of see the divergence in the two paths, without having the recession. If you're looking at the average return, that correction, to everyone's point that we've kind of made, this is a really good buying opportunity as you kind of see it above, the typical S&P performance trend, where, if there is a recession, you're kind of staying along that path of, being down that 10%, basically over that next year. So I think that really just kind of puts into perspective a sense of, what should be kind of happening within a portfolio. And how to kind of think about different potential outcomes that might come from this, and even after, when there is eventually another decline, how to kind of think about it.
Yeah, so just for those who are looking at this chart and see a bunch of lines and it might be a little confusing, the gray line that's kind of just drifting directly up, that is the average performance for the S&P, just generally speaking, what directionally it should be. And then the bluish line, that's showing a 10% correction that is followed by no recession. So you can see the market kind of bottoms out and then recovers pretty sharply and quickly. The purple line is 10% decline, and then there's a recession. And these are the averages of the numbers. And this is from 314 research. So, that's I don't know if I'd necessarily present exactly like this, but we thought it does kind of paint a picture, which is, most of the time, after your 10% decline, you're not really ahead of the crowd by selling at that point. So far, I would say if we just look at what's been happening, we've had a 10% decline from a recent high, and it's started to recover. So we've seen a little bit of that recovery. We're not sure where it goes from here and if we go into a recession. Right now, growth forecasts are coming down, but I don't think recession estimates have moved up materially enough, and we're not really seeing it outside of consumer sentiment and a little bit of earnings concern. But again, it's so tough to tell this early in a new administration and with so many changes going on. It's tough to predict, but either way, it's something we're keeping an eye on.
Well, I think this is all, really relevant data. I hope everybody enjoyed the presentation and some of our banter back and forth. Obviously, if you guys have any questions, any concerns, or any people that you believe might benefit from having a conversation with us, connect with us directly. Never any strings attached. There's always an opportunity for us to have good conversations with good people. And sorry we went over about 20 minutes, but a couple questions and getting into some of the data, I think was worth the extra time spent. Last thing I want to say is we miss you, Sean. See you on the next investment committee. Hopefully you're watching from your bed and not, keeled over and halfway dying. Jord, any parting remarks?
Yeah, someone just
Randall?
asked. What one thing that someone asked on the question is, what should we be watching over the next month to figure out where things are going? And I don't think that economic data is probably the thing to be watching too heavily. The thing that I'm personally watching a little bit more, I'm watching some of the leading indexes. I'm watching some of the leaders. If you saw something like NVIDIA starting to break down significantly, that's not a great sign. That tells you people are moving out. So, I think you want to watch really the markets and how they're behaving in this environment. And if you see them, trading weak, or you hear good news and you see a market down and you're scratching your head, that's really not a good sign of where investors are going. On the flip side, I think if the market holds in here, I think if you see cryptocurrency and Bitcoin, which is usually a good assessment of people's risk appetites,
Crypto, go, baby.
it's a good
Oh,
litmus test. So
let's go.
if Bitcoin keeps going up, that tells you people are a little bit more risk on.
Risk
If
appetite.
Bitcoin going down, then that tells you people are a little bit more risk off. So I think you got to watch the canaries in the coal mine, and those are going to be the things that have been some of the biggest gainers over the past couple years, and that would be NVIDIA, that would be cryptocurrency and Bitcoin, and that would probably be Tesla's probably another good litmus test for where the market's ultimately heading. If you saw Tesla breaking down from here, that would cause concern. If you saw Tesla breaking out back up towards above 300, I would think the market would also follow suit. All right, guys.
That is a wrap. The investment committee done for March. See you guys in April, and we'll have this video up and we'll disseminate it out. And anybody who wants any other information or has any questions, please feel free to reach out. Thanks, guys.